Hi everyone, in this video I'll be sharing a few things that have been true eye-openers for me when it comes to investments. I recommend everyone who is considering investing money to give these things some thought, so keep watching. Hi there, Theresia here from Lead Yourself. I'm helping you to lead your life towards more freedom and more happiness by providing insights and tips on how to improve your life when it comes to time, energy, and money. If you're new here, consider subscribing. So today I want to share a few things with you. And the first thing I want to talk about is predicting the future, or rather the fact that you can't. Nobody can. And why is this important? Because in order to not end up losing a lot of money that you invest, you must realize that you will never be able to tell with certainty what's going to happen tomorrow or a year from now. There are a few things in particular to watch out for. First, trying to time the market can sometimes be good if you're lucky to actually end up doing so. But how can you know that the time is right? Will the price go up or down tomorrow? You can't know that, and the best thing to do instead is to spread out your investments over time. Never invest all of your money on the same day. Instead, split up larger amounts. Another thing to realize is that financial advisors and professional investors can't predict the future any more than you can. Be wary of funds that claim they are beating the market based on a 5-year history. That says nothing about the future, but they tend to have a higher cost associated with them due to their historical record. Realize that banks and financial advisors want your money and will usually not recommend cheap alternatives. Always check the prices of the financial products you invest in. This needs to be subtracted from your return of investment. So learn to trust your own judgment and never agree to investing anything on the spot. Say you'll think about it and do so without the pressure of a so-called advisor sitting in front of you. Even if the advisor doesn't cost you any money directly, he or she usually gets a share of the cost you will be paying for your actual investment. So you can't tell the future and you can't trust anyone else to do that either. But what can you do? Well, you can realize how the market works. Money usually doesn't disappear from the market for long, but it may move around. Now, what does this mean? For starters, it means that the amount of money in itself has a way of increasing due to the way the global economy works with inflation and new money being printed. People who have money to spare are usually the ones that try to find good investments so that the value of their money is safe and can increase. As long as there is a willingness to put money to work by the means of investing, rich people won't usually keep all of their money as cash under the mattress. The result of this is that in times when the stock market is shaky, people sell off their stocks and put money towards other forms of investments. One of those is gold. Gold has a way of increasing in value when stocks decrease in value. It's viewed by investors as an insurance and a go-to investment when the stock market falls. There are other types of investments as well, for instance bonds and even cash. There are also 4 different states the market can be in, and they are all beneficial to certain types of investments. The first is prosperity, when the economy is growing. Business is good, living standards are increasing, and interest rates are falling. Prosperity favors stocks and long-term bonds. The second is inflation, when prices go up and money decreases in value. This usually favors gold. The third is deflation, which is the opposite of inflation, meaning the value of money increases and prices decrease. This usually causes interest rates to fall and favors long-term bonds. The fourth is tight money or recession. This is a state where the money in circulation slows down and basically makes people have too little cash. This will most of the time lead to recession. Interest rates are rising and the only favorable investment is cash. Luckily, this state is usually temporary and the market usually adjusts pretty quickly one way or another, leading to one of the other states. So what you can do is to diversify your investment over the different types of assets. So you invest broadly into the market as a whole and your portfolio will have a much more even value graph due to the different asset types that are essentially balancing each other out. Another way to put it is that you have reduced your risk. You then regularly perform so-called rebalancing, which means that you sell off assets that have been doing well and buy assets that have not been doing that well. This seems very counterintuitive when put that way, and there are many mental traps related to that. But the fact is, by doing this, you will automatically be buying cheap and selling expensive without trying to time the market. You might also consider diversifying over time, as we talked about before, as well as over location, investing in markets all over the world. Now let's talk a little bit about the mental trap we just mentioned with buying when things go badly and selling when things go well. The investment market works totally different from the mall. When there's a huge discount at the mall, people want to buy. But when there's a discount at the stock market, people will tell you to stay away. Most newbies buy when things go well and sell when things go bad, which results in very little profit and maybe even a loss, as that means they're buying expensive and selling cheap. You should be buying when nobody else wants to buy. Investing broadly in the market when you essentially have a discount is a much lower risk than investing when things are at an all-time high. In any case, you should probably get used to doing the opposite of what other people do. But in order to not be tempted to do things in panic or in hope, which are two mental states to be very careful with when it comes to investments, you're better off if you can remove yourself from the equation. So try to automate as much as you can of your transactions, or if this is not possible or practical, act like a robot when you buy and sell and have a very clear plan of all the numbers before starting. Having a high-level investment strategy is also good for keeping you from falling into mental traps. You might also consider a hands-off policy and maybe even an eyes-off policy, especially during shaky times. Being like an ostrich and putting your head in the sand can actually be a good thing here. Just don't watch the numbers when things go south. Trust your strategy. My personal strategy is never to sell anything. I perform all of my rebalancing by investing new money. This strategy works for me as I have a lot more money already invested than I have coming in. So if I have a weak moment when buying, the impact isn't nearly as high as it would be if I had a weak moment selling. I'm also in it long term, which means I don't plan to sell until I've built a big enough portfolio to sustain me. And using the knowledge that I've shared with you today, I've come quite far on a pretty average salary, and I believe so can you. If you'd like to learn more, I highly recommend reading the book Fail-Safe Investing by Harry Brown, and I'll put a link to it in the description. And with that, I'm wrapping up this video. I hope you get some value out of watching it. Let me know if you did in the comments, give the video a thumbs up, and subscribe and hit the bell for more videos like this. Now, thanks for watching. Bye!